Trading. Now, you are probably curious and would really want to know how forex trading really works, or let me take this thing serious because I've seen people trade forex, buy luxury cars, live the best of life, travel, and then have the best phones and everything really nice, and everybody is talking about it on social media, and it's like you that is not into it, it's like you don't have anything serious with your life. How does this really work? Do I really need to know calculus or calculations or anything related to mathematics and all of that? All of your questions, I'm going to break it down in this video episode. How to start forex trading, how forex trading is, how you can start taking advantage of it with your smartphone or any gadget to start cashing out in the forex space. What tools do I need to procure before starting up Forex? This is one of the common questions beginners in Forex always ask, and the answer to this question is simple. Any regular smartphone or laptop is very suitable in Forex trading. All be done is to make a download either from your Google Play Store or your Apple Store, an app which is called the MetaTrader, as well as your trading analysis platform, either the Trading View or the Go Charting. Now, what is the MetaTrader? The MetaTrader is an app that connects a forex trader to the market. Hence, the MetaTrader as an app or a platform brings the forex trader to the market where the buying and selling of currencies will take place. Why the trading analysis platform is a platform that enables a forex trader to be able to carry out his or her analysis before entry on or executing a particular trade in the forex space. Now, what is forex and what is forex trading? In the most basic terms, forex stands for foreign exchange. Is basically the market where you can buy and sell currencies from around the world. Forex trading is when you participate in this market to make a profit. You do this by exchanging one currency for another, hoping that the currency you bought will increase in value compared to the one you sold. It's like trading money for more money. People trade forex for various reasons, such as making money, hedging against risk, or simply for speculation. It's a global market that operates 24 hours a day, 5 days a week, meaning it's open from Mondays to Fridays every single week, and is one of the largest and most liquid financial markets in the world. It has a liquidity of about $6.3 trillion every single open market day. Remember, just like any form of trading, forex trading involves risks, so it's essential to educate yourself and proceed with caution. People trade forex for various reasons, such as making money, hedging against risks, or speculation. Now, there are different participants in the forex space. We have the profit participants and we have the non-profit participants. Now, examples of the profit participants are the major banks such as the JB Morgan or the Chase Bank. This is where the liquidity of forex lies. We have the normal banks such as your local banks like the First Bank, the GT Bank, the Access Banks. I'm just making examples of local banks here in Nigeria. So we also have local banks in every single country in the world. We also have another example of markets or profit participants is the hedge funds. The hedge funds, the speculators, and the individuals like you and I who trade forex, who are traders, as well as those individuals who travel from one country to another, exchanging currencies from one form to another. So we also have the non-profit participants. Now, this category of persons, they are into forex not for profit making, but for the purpose of control, such as the central banks of every country. Now, all what they do is to make sure that their country's currency is stabilized. It's always at equilibrium, a straight line, meaning whenever a country, so let me make an example. Let's take for instance the United States of America Central Bank. So whenever there's a recession in the United States, where the United States dollars tends to depreciate in value, the central banks of the United States will come into action to make sure that there's a control and there's a stabilization of its currency to reduce the depreciation of the currency. Same applies to the UK, to Canada, to Turkey, to South Africa, to Nigeria, to every single central banks worldwide. All what they do is to make sure that their local currency is not depreciated. So those are the category of institutions that do not participate in forex for profit making, but rather for control and for stabilization of their currencies. While every other category of persons, such as the major banks, the normal banks, the hedge funds, speculators, and individuals, they are all in forex space for profit making. Now you will be wondering, how exactly do people really make money in forex? Certainly, in forex trading, people make money by selling and buying one currency for another, aiming to make profit from the changes in exchange rates between them. Here is a simple breakdown. Forex trading involves trading currency pairs like the Euro USD or the Great British Pounds USD. When you buy a currency pair, you are essentially buying the base currency, which is the first currency, and selling the quote currency, which is the second currency. I'll be explaining what a base currency is and what a quote currency is. Secondly, through speculations, traders speculate on whether the value of one currency will go up or down compared to the other. If they believe the base currency will strengthen against the quote currency, they buy the pair. If they think it will weaken, they will sell the pair. They also profit from price changes. Let's say you buy Euro USD at 1.100, meaning when 1 euro equals 1.1 United States dollars, if the exchange rate rises to 1.1200, you can sell your euros for more US dollars, making a profit. Conversely, if the rate drops to 1.0900, you would sell your euros for fewer US dollars, resulting in a loss. We also make profit through leverage. Forex trading often involves leverage, which allows traders to control larger positions with a small amount of capital. While leverage can amplify profit, it can also increase the risk of losses. Also, one of the most common terminologies in forex that you have to know as a forex beginner is the base and quote currency. In forex trading, currency pairs are always quoted in terms of two currencies, the base currency and the quote currency. Here is a simple explanation. The base currency is the first currency listed in a currency pair. It's like the starting point of the trade. For instance, in the Euro US dollars pair, the euro is the base currency, while the quote currency is the second currency listed in a currency pair. It represents the value of 1 unit of the base currency. In the Euro US dollar pair, the US dollar is the quote currency. To put it even simpler, think of it like buying something in a store. If you are in the United States and you want to buy something priced in euros, you will need to know how many US dollars it costs. In this case, the euro is the base currency and the US dollar is the quote currency. Understanding base and quote currencies is fundamental because they determine how much of the quote currency you need to buy 1 unit of the base currency. This exchange rates fluctuate based on market demands and supply, and that's what forex trading is all about. There are also two kinds of currency pairs. They are known as the major currency pair and the minor currency pair. Now, the major currency pairs are pairs that involves or includes the United States dollars. For instance, we have the GBP USD, we have the Euro USD, we have the USD JPY, the AUD USD, NCD USD, USD CHF, and the USD CAD. Now, all these includes the US dollars, either as a base currency or as a quote currency. Now, before going any further, let me explain some terminologies. Now, when you hear something like the GBP USD, the Euro USD, now the first two letters represent the country. Now, take it for instance, GBP USD. Now, GP means Great Britain, while the third letter represents the name of the currency. Now, GBP simply means Great British Pounds. Also, the USD, US means the United States, while the last letter represents the name of the currency, which is the dollars. Pair represents the base currency, while the second pair represents the quote currency. Now, in this case, GBP USD, the US dollars is the quote currency. Euro US dollars, the US dollar is the quote currency. USD JPY, the US dollar is the base currency. AUD USD, the USD is the quote currency. NCD USD is the quote currency. USD CAD, USD is the base currency. So the first currency is regarded as the base currency, while the second currency is regarded as the quote currency. Now, any pair that involves the United States dollars are all regarded as a major currency pair, while any pair that do not include the United States dollar is regarded as a minor pair. Example: the Euro GBP, the Euro CAD, the Euro NCD, EU AUD. All these are examples of minor currency pairs because they do not involve the United States dollars in its pairing. Another key aspect of forex trading are some terminologies assigned to it, which are the pips, the ask price, the bid price, and the lot size. Now, here, pips are tiny units of measurements in the forex market used to describe changes in currency prices, meaning these are the steps that forex follows. In other words, forex moves in steps, and these steps are called pips. For most currency pairs, 1 pip is equal to 0.0001. This is what it means. A pip is the fourth digit after the decimal point. Now, on this chart, on this Euro USD chart, now the pip is the fourth digit after the decimal point. Now, after the decimal point of this price is 1.1278. So after the decimal point, the first digit is 1, the second digit is 2, the third digit is 7, and the fourth digit is what? 8. Now, the fourth digit after the decimal point is what we call a pip. That's what we call what? A pip. So now on the left hand side we have 1.1278, while on the right hand side we have 1.1289. So from the left hand side we can notice that this pip position is what? Is 8. This fourth digit after the decimal point is 8, while on the right hand side the fourth digit after the decimal point is 9.
So the difference between the right hand side and the left hand side will now be 9 minus 8, which is what? 1. Now moving on to this other chart, which is the Great British Pounds USD. Now the fourth digit after the decimal point, which is 6 on the left hand side, while on the right hand side the fourth digit after the decimal point is 7. So when you do the subtraction, you have what? 1 pip. Another crucial term used in Forex is the lot size. Now, the lot size determines a trader's buying or selling capacity in the Forex space. One standard lot represents 100,000 units of the base currency. So in Forex, a lot is a standardized unit of measurement that represents the amount of currency a trader can buy or sell in a single trade. The standard lot size is 100,000 units of the base currency, which is the first currency in a currency pair. Now, for the sake of beginner's guide, an example of a lot size or practical illustration of lot sizing is this. Take for instance the richest man in Africa, which is Dangote, as at the time of making this video, has the ability of purchasing 1,000 iPhone, but I myself as an individual am able to purchase 5 in numbers. Now let's assume an iPhone cost $1,000. Now if I'm able to purchase 5 iPhone which costs $1,000 each, it means my total cost or my total buying capacity is going to be $5,000, while that of Dangote, which is the richest African man, will be 1,000 times 1,000, which is $1 million buying capacity. Purchasing these iPhones today, and let's assume the prices of the iPhone increased from $1,000 to $1,100, which is $1,100 per iPhone, and I've been able to procure just 5 pieces. So it means I'll be making a profit of 5 times 100, because I bought an iPhone for $1,000, but now it is selling at $1,100. Means I'll be making $100 per iPhone. So and I bought 5 units or 5 pieces, meaning I'll be making $500 as my profit because of my buying capacity, my initial buying capacity. While that of Aliko Dangote, which is the African richest man, he will be able to making $100,000 in profit, while I myself will be making just $500. Why? Because of the difference of our buying capacity. So this is what lot size means. So we have the standard lot size, we have the mini lot size, while we have the micro lot size. Now the standard lot size is the largest lot size in forex trading and represents 100,000 units of the base currency. The mini lot size is 1/10 of a standard lot, representing 10,000 units of the base currency, while the micro lot is 1/10 of a mini lot, representing 1,000 units of the base currency. Now, lot sizes allows traders to control larger positions with a smaller amount of capital. For example, if you are trading a standard lot of Euro US dollars, each pip movement is worth $10. If you are trading a mini lot, each pip movement is worth $1, and for a micro lot, each pip movement is worth 10 cents. Understanding these terms is crucial for forex beginners as they form the foundation of forex trading and help traders manage their positions effectively. So a standard lot represents 100,000 units. This volume represents standard lot. This volume represents lot size. So one volume or one lot size is what? A standard lot, and that represents 100,000 units. And a pip of a standard lot is $10 per pip. That of a mini lot is 10,000 units, and its value is $1 per pip. While a micro lot is 1,000 units, while its value is 10 cents per pip. Most brokers makes use of standard lots, mini lots, and micro lots. Only on some derivatives, that's where you're able to see nano lots, which represents 100 units. Now, this unit might seem confusing at the moment, but I'll be explaining what units in Forex represent. Earlier on, I made mention of the open times of the Forex market hours, but now I'm diving deep into it. In Forex, we have different sessions, which are the London session, New York session, Tokyo session, and Sydney sessions. Now, understanding Forex market hours is essential because it helps traders know when the market is most active and when to expect increased volatility. It's also important to consider different time zones when planning your trading activities. Now, the Forex market isn't tied to any specific location or exchange because it's a global market where currencies are traded electronically over the counter. This means you can trade currencies from anywhere in the world as long as you have access to the internet and a trading platform. Now, here are the sessions. Although the Forex market is open 24 hours a day, it's divided into different sessions as can be seen right here. The main sessions are the Sydney session, as earlier stated, which opens at around 10 p.m. GMT or 5 p.m. Eastern time. Now, this chart right here shows the instant time. The 5 p.m. is when the Sydney gets opened and closed at around 7 a.m. GMT, while the Tokyo is the next session. Tokyo opens at around 12 a.m. GMT or 7 p.m. Eastern time and closes at around 9 a.m. GMT or the 4 a.m. Eastern time. While the third session is the London session that opens around 8 a.m. GMT or the 3 a.m. Eastern time and closes at around 5 p.m. GMT or 12 p.m. Eastern time. While the last but not the least session is the New York session that opens around 1 p.m. GMT and closes at around 10 p.m. GMT. I check that again. The New York session opens at around 1 p.m. GMT or 8 a.m. Eastern time and closes at around 10 p.m. GMT or 5 p.m. Eastern time. Now, on this chart, there are times where there is an overlapping session between each sessions, like the Sydney Tokyo, the Tokyo London, the London and New York. Now, during these overlapping sessions, the most active trading hours occurs during the overlapping session when multiple markets are open simultaneously. For example, the London and the New York sessions overlap for a few hours, creating higher trading volumes and increased volatility. Same applies to the Sydney Tokyo and the Tokyo London. While we have the weekend break, the Forex market is closed on weekends, which is the Saturday and Sundays, but trading resumes as usual on Sunday evening when the Sydney session opens.
Now, before I explain what units are in Forex, there's a key term that needs to be explained, and that term is brokers and leverage. Now, in forex trading, brokers are the companies or firms that provide access to the forex market. They act as intermediaries between traders and the interbank market, where the actual buying and selling of currencies takes place. Here's how it works. When you want to trade forex, you open an account with a broker. The broker provides you with a trading platform that allows you to place trades, analyze the market, and manage your accounts. You deposit funds into your trading account, which you can then use to buy and sell currencies. When you place a trade, the broker executes it on your behalf and charges a fee or spread for their service. It is important to choose a reputable broker with a good track record, reliable customer support, and competitive pricing. Secondly, we have leveraging. Leverage is a tool that allows traders to control larger positions with a smaller amount of capital. It's like borrowing money from your broker to increase your trading power. Yes, how it works. Let's say you have $1,000 in your trading account and your broker offers you leverage of 100 to 1. With 100 to 1 leverage, you can control a position size of $100,000, meaning $1,000, which is your initial capital, times 100. So it means your broker is willing to offer you 99% of the money, which is $100,000. So your broker is willing to offer you 99% of the funds, while you are just to bring $1,000. This means that for every $1 you have in your account, you can control $100 in the market. Leverage can amplify both profits and losses. While it allows traders to potentially make more money with a smaller initial investment, it also increases the risk of losing more than your initial deposit. It's important for beginners to use leverage cautiously and understand the risks involved. In summary, brokers provide access to the forex market, while leverage allows traders to control larger positions with a smaller amount of capital. Both are essential aspects of forex trading, and understanding how they work is crucial for success in the forex market.